And now let us proceed to the foreign exchanges. So what is foreign exchange? Foreign exchange or forex is the conversion of one country's currency into another. In a free economy, a country's currency is valued according to the laws of supply and demand. In other words, a currency value can be pegged to another country's currency, such as the US dollar or even to a basket of currencies. A country's currency value may also be set by country's government. However, many countries float their currencies freely against those of other countries, which keeps them in constant fluctuation. So if you travel to foreign country, you may have needed to exchange your money. So you have already participated in forex trading. So halimbawa, when companies buy goods from another countries, in order to buy them, so kailangan magpapalit muna sila ng currency doon or yung local currency. So exchanging going around the world, the exchange rates constantly move. This is how it works when currencies are exchanged. They have a certain price increase. So na-determine ito so based sa law of supplies and demand. Kumbaga, kapag yung demand ay nagtaas, tapos yung supply naman is nagbaba, syempre yung value ng goods is tataas. Factors affecting currency value. The value of any particular currency is determined by market forces based on trade, investment, tourism, and geopolitical risk. Every time a tourist visits a country, for example, they must pay for goods and services using the currency of the host country. Therefore, a tourist must exchange the currency of their home country for the local currency. Currency exchange of this kind is one of the demand factors for a particular currency. Another important factor of demand occurs when a foreign company seeks to do business with another in a specific country. Usually, the foreign company will have to pay the local company's currency. In other times, it may be desirable for an investor from one country to invest in another, and that investment would have to be made in the local currency as well. So the first reason, which is usually the fluctuation in increases in the inflation differential, when inflation is low, things are cheaper. That means you can buy more with one unit of currency. So meaning to say your purchasing power is higher. And what does higher purchasing power? Simply means has more value. On the contrary, when a country's inflation rate is higher, it means items are more expensive. So mas kaunti lang yung mabibili mo pero same lang yung amount ng money. So isa pang example, yung political and economical stability. Just like us, the market creates stability and a strong stable economy. Pero when the goods and services is from the other country, syempre, it also affects our value currency. So next, how inflation affects foreign exchange rates. So when inflation is high, it makes a currency weaker, suppressing investments and thus negatively impact in the exchange rate. Inflation can have a major effect on the value of a country's currency and its foreign exchange rates with other countries. While it is just one factor among many, inflations is more likely to have a significant negative effect on a currency values and foreign exchange rate. A low rate of inflation does not guarantee a favorable exchange rate, but an extremely high inflation rate is very likely to have a negative impact. Inflation is also closely related to interest rates, which can influence exchange rates. The interrelationship between interest and inflation is complex and often difficult for currency issuing countries to manage. Low interest rates spurs consumer spending, the economic growth, and generally positive influences on currency value. If a consumer spending increases and demand grows to exceed supply, inflation may ensue. So, which is not necessarily a bad outcome. However, low interest rates don't usually attract foreign investment the way higher interest rates can. So higher interest rates attract foreign investment, which is likely to increase demand for a country's currency. But when the rate of inflation rises rapidly, It can result a lower purchasing power. Higher interest rates makes slower economic growth and other negative economic effects.